Welcome to another weekly market insight where we try to sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week, as all weeks, one of our analysts, Chris Arends. It's good to have you here.
Great to be back. We missed a lot while we were gone that 1 week.
Yeah, well, Friday was a pretty rough day, wasn't it? Was it that there just isn't anybody in the market, or was it OMG Omicron? Am I saying it right now?
Yeah, you got it.
I got it?
Yeah.
It's not Omicron, it is Omicron, or Omicron, because Omega, Omicron. We missed new and she. Why did we skip those? I guess new sounds like a new variant, but isn't it always a new variant that they're talking about? And she is a common name, or for the conspiracy-minded, it's also the name of the president of China. Do you think I'm going to get canceled for that?
Yeah, probably, yeah.
I'm going to get canceled from that? I don't know that YouTube cares about that. So, shows up in South Africa, Omicron, and it certainly spooked the market. There was fears, and continues to be fears, of an additional lockdown.
Like you said, that was Friday, day after Thanksgiving, half day in the market hours, so tend to be a little bit volatile.
What was really interesting is when I looked at it early in the morning, I was looking at the futures at like 4 in the morning. I just happened to peek at the futures out of habit, and I noticed that the Qs were pretty much flat, while we had the small cap and Dow Jones Industrial down 2, almost 3%. And that spread at the open was pretty big. It looked like the market was pricing in a lockdown. Right. But by the end of the day, it was still a sell-off day, but the Qs had dropped, and it seemed to be more of a taper pricing at that point by the end of the day.
It was the similar playbook we always see with these variants popping up, right? Zoom, Peloton, DocuSign, the work from home stocks were green on the day. Yes. And the reopening travel was down. Bonds, treasury bonds were purchased, and yields went from 1.65 all the way down to 1.45.
If memory serves me right, I think oil was down 7% at open. It was a pretty rough morning.
Don't need oil in a lockdown.
So it was coming out of South Africa, but it probably isn't showing up from South Africa. It is the most read, so it certainly is a place, but we can see it's pretty much global. And one of the concerns is how effective is the vaccine? Well, if we zoom in here, Australia, I know it's a continent, but it's also an island, and they have restrictions on travel on entry, which is pretty much, if you're going to go there, you have to be vaccinated. And we can look at here on the recommendations. Now, sure, you can be under 5 years, and maybe you're getting in there through an exemption, so it's not clean, but it's a brand new variant, or at least discovered newly. So if the vaccine was able to prevent the transmission of that, we probably wouldn't see any of the variants in Australia, and we do. Well, that's what we've known about the current vaccine is it doesn't do a great job on stopping transmission. It kind of knocks down the severity of the symptoms.
And lots of mutations, right?
Lots of mutations. But Moderna has come out, and yesterday, I think it was yesterday, maybe it was Monday, I'm getting my days confused, the market sold off on the CEO saying, most likely not effective against the new variant. They assume 100 days?
Yeah, that was Pfizer. So Pfizer said they'd take about 100 days to update the vaccine for the new variant. They said they think their pill will still be effective. That's still, trying to get approval. But
right. Their stock was kind of hit also.
100 days pretty fast scientifically, but maybe a little slow for the market.
Or also the variants, right? We're already at Omicron. I know we skipped new and Psi or Shy, however you want to say it. But we've come from Delta in a pretty quickly. So whatever it is, we'll probably have a new variant by the time this would be out. So then really let's just think about how the market is going to react, because we think there are really 4 things. Because one thing that we know is the vaccine is not effective, or I think that we can say is a fairly good certainty, is that it's not effective on transmission. So the 2 things that you want to look is how severe is the symptoms, and how transmittable, how infectious, that's the word I'm looking for. I even have it up there on the screen. So if it is more severe than, let's say, the Delta variant, and it is more infectious, I think the market's going to be very bearish. We're going to have lockdown 2.0, things will be very restricted, and it probably isn't going to go away until there's an effective vaccine. So it would be vaccine dependent upon that. Now, what if it's more severe but less infectious? Well, it's probably not as severe as the first, because it will spread slowly, giving us more time to deal with it and adjust. So I would expect high volatility, especially on the downside in the market. So still a little bit bearish, just not a sharp sell-off like the previous lockdown. And there will continue to be supply chain issues out of that. So either of those scenarios are possible, and those are bearish scenarios. But what if it's less severe and more infectious? That seems like that could be bad. Actually, that would be really good. Long term, that would be very bullish because, one, no vaccine would really be needed because it would spread so quickly. Most people would have natural immunity. And I think of this as like the cowpox vaccination. When Jenner put that out, it was that he noticed that dairy maids that had had cowpox didn't get smallpox. He inoculated with cowpox some children because that gave them prevented smallpox, which was deadly. So the less deadly, the less severe versus the other one, that would actually act as a natural vaccine to this. So we would say that we'd probably get out of this pretty quick if it was very, very infectious. And what if it's less severe and less infectious? It's a nothing burger. We're just going to pass through. There's really not much to be worried about. So,
do you think it's too early to start assigning probabilities to any of these? And we haven't made any changes yet in the portfolio. Kind of referenced large cap stocks, really not down that much, 1, 2, a little over 2%. It's the small and mid cap that are still down about 5% from last week.
So let's look at just how infectious and how new the variant is, because my guess is it's not that new. It's been around for a little while. It's just discovered here in South Africa. And if we go to South Africa, we can see how cases on the top have moved up and then deaths. And we definitely see an increase in cases. But if we go back a year, we can see, well, there seems to be some seasonality to this. So it may not be that the Omicron is that much more infectious and we're seeing all of these. It could just be a seasonal effect, and it just happens to be the latest variant that's been out there. So all of a sudden the environment is better for the coronavirus in South Africa, and that's moving up. So it's seasonal. And when we look at the death rates currently, it's still too early to tell because it takes a couple of weeks to see that time. If we remember going through this last year, there is a lag, but it doesn't look to have much more of an exponential slope from the previous. And then once again, seasonality. We can look at that here. I know that the southern states were kind of beat up in June, July when it was their time for COVID to come back. And we had said, well, most likely we'll get through that because it's seasonal. It happened the previous year, and then it would move up. And we can see that that's pretty much what's happened. The map is a little less severe on red because there's more and more people with natural immunity or vaccination status. We're not as infectious or susceptible to infection, but we can see that it pretty much looks just like it was the previous year. Most likely this is a seasonal effect and not necessarily a more severe or more infectious. But we will be paying attention. I will not pronounce the name correctly. Gauteng in South Africa. We'll be looking there. We can see that there has been an increase in deaths, but it doesn't seem to be that much more different than previous case rise in those seasonal reports. And then Bill Ackman, hedge fund manager, is certainly out there looking at it, and he's saying, no, this early data looks like it's not going to be that effective. But is there any conflict of interest there?
He's very honest that his book of business is he's positioned for rates to increase.
Right.
And when you get a scare like this and rates come down 15 basis points, he lost a lot of money.
Right. So in 2 weeks, he's either going to be right or he's going to lose a lot of money, right? So we'll find out whether it's conflict of interest or not. Maybe he's trying to exit his positions while he's doing that. But whenever I'm looking at the data, I kind of concur with this. So far, I haven't seen anything that says this is marginally different than the previous. One thing that I don't think has caught the news, I've seen it some places like in the New York Times, I know they have reported on it, but mortality is higher in 2021 than 2020. So we have the vaccines this year, but we have a slight increase in deaths relative to 2020. Now, one of the things that we suspected was that because people weren't getting the proper medical care, they weren't getting in and they weren't getting their cancer screenings, they weren't dealing with some of their heart disease, we expected mortality to remain high. Is that the cause of this? Not sure. I also know that there's a lot higher suicides, a lot higher drug overdoses, and these are things that we think need to be considered whenever we are talking about lockdowns, because they could be exasperated because of those lockdowns. So there is no such thing as a free lunch. We can see mortality is still high, and remember 2020 had a lot of excess deaths. So if we were to put in and graph in 2019, we would still see a marginal shift up over these last 2 years, despite all the things that has been done to try to prevent that. And then we have the Fed. We have taper talk, right?
Yeah, well, even before that, Biden did renominate Powell to remain as Fed chair, and there was some talks about maybe Lyle Brainerd taking over the spot, but probably a political decision that, changing hands, and then Biden would really have to own it if inflation still becomes a problem. Right now, he can still blame status quo if he kept Powell in charge.
This was Trump's pick, right?
Yeah.
Absolutely. And then one of the things that we have said is that inflation we did not believe is transitory. Now, Chairman Powell said we're going to retire the word transitory. I don't know if the Webster Dictionary has gotten the memo that they're supposed to take that out. And I've seen a lot of victory laps pointing to core CPI where it's at 2% and say transitory 1. I think it's way too early to say that. Actually, I would say the transitory message is going off because inflation doesn't appear to be transitory. It's really showing up in energy and food, but it actually has been a good reprieve in some of those indexes on commodities to see a lockdown threat. It actually pulled some of that price out, and maybe that stopped some of the momentum. So maybe we get a little bit of a break here on inflation because of that. And then we have interest rates possibly moving up because of that taper talk.
This was yesterday in
the
Senate hearing, and I think the expectations were really that Powell was going to be very accommodative, right? New variant, and they'd be talking about easing, slow the taper, maybe slow the bond buying, and instead he said, slow the taper, yes. And instead he said, well, we may actually have to start tapering much sooner. So that scared the market.
What I want to emphasize is Friday's beginning sell-off was because of lockdown threats.
Yep.
This current one is because of interest rates, and different asset classes have responded differently to that. So if it's a lockdown, you want to be a high growth, large cap. If it's the taper, you may want to consider some value. And we've been hedging our portfolio for either of those scenarios, whichever one materializes. We still think inflation risk is high. We're hoping that this commodity sell-off will help bring some of that back off the indexes. We continue to favor equities over fixed income, especially if interest rates are going to go have the potential to go up. We continue to favor the U.S. domestic market and continue to favor technology, even though they may kind of hit a little bit of a road bump if we do see interest rates move up. We think it'll just be a nice J curve as they take a pause and then move up at a faster pace. So then market, looking at probably testing that 50-day moving average to get through this. Probably then head on to new highs. We'll see. We're watching the money supply for sure. We're past the season here where money supply was declining. That was concerning. We're now moving into pretty solid growth, so we don't see a lot of issues whenever it comes to that monetary policy. We are looking at that yield curve, though, because it is flattened.
So just to point out, that green line is growth rate, right?
Right.
We're seeing it starting to increase just a little bit.
Yeah, so that's the growth. So we can see that yellow line, that parabolic, looks like St. Louis, the arch. That was 2020, the lockdown, and the amount of money that was created. If you go back for the last, I think, 18 months, or basically you capture it, there was a 20 to 25% increase in all the money that in U.S. dollars that have ever been created were created during this time frame. So that is a huge bump to deal with, and this is ultimately the reason of inflation. I know we have some issues with supply chains, but a lot of that is because there's so much money going in, and now they're importing all of those goods, and it's bottlenecking. So it's still going to be a monetary phenomenon that's causing that inflation.
And that supply chain was actually something Powell referenced yesterday with, some of the new variant maybe reducing some of the labor growth rate. So he was concerned that would actually hurt supply.
I think it would. I think it could be. We would see some things sell off. Energy, there's not going to be as much gas, but there's still going to be bottlenecks in supply chains. And especially if they were doing another stimulus package where people still have more money to spend, but we're not getting those goods in, and we don't have the people to actually drive the trucks to get them here, that's going to drive up prices. So I don't think the inflation risk is gone just because we may be going into a lockdown. Looking at the our relative strength at S&P 500, that blue line moving up to the top, that means it's better to be in the S&P 500 than a diversified account. It gets a little bit more difficult to beat. Thankfully, we have overweight to large cap growth, NASDAQ 100. We do have some U.S. real estate in the mid value and small cap growth, which I think is odd that it's mid value and small cap growth and large cap growth. There's some reasons there, energy and finance kind of running, and some other things inside the index that you'd have to look at. But we're still, this favors our allocation, and whenever you look at how we're made up, especially in Signal, where we have the Qs, large cap growth, counterbalanced by some small cap value and mid-core and mid-value. Either one, whether we go in a lockdown, we have things to hedge that. If we see inflation or we see interest rates move up, we've kind of hedged that. That does mean that we probably won't be adding a lot of excess return to the benchmark because there's really no trend to follow. We're mainly hedging, trying to stay relative to our benchmark. Anything that you want to add?
No, I think we got it.
All right, well, we really appreciate you tuning in. If you haven't subscribed already, click down there. And if you know of anyone that could benefit from this, please share. And if you like Chris's marker, make sure you hit that like button off to the side. It makes me think of Bob Dole. I think he's too young to remember. See you next week.